The U.S. unexpectedly lost 92,000 jobs in February, with economists expecting a 55,000 gain for the month. The unemployment rate also ticked higher, and as a result, futures are down sharply. We see yields off across the curve. Bloomberg's Michael McKee, our national policy and economics correspondent, joins me now on set to kick off Bloomberg Open Interest. Mike, thanks for coming on to the desk. What are you seeing here that doesn't make sense? Because obviously you'd see the yields sell off, but I would expect futures to rise as equity investors price in rate cuts.
I think the confusion about what's going on and how long this is going to last in the Gulf, Persian Gulf, and how long energy prices are still going up has got people worried about what's going to happen next. They just don't have an off-ramp at this point. And the numbers were bad this morning, and you can see the reaction in the markets when those came across. 92,000 jobs lost. And one of the interesting things here is the only category that's been hiring lately is healthcare, and healthcare had almost no jobs during the month, and physician services lost 37,000 jobs, and that was because of a strike at Kaiser, 31,000 people. But if we can't withstand one strike like that in the labor market, you got a problem. And we see that the unemployment rate went up to 4.4%. Labor force change was only 18,000. People thought that maybe there would be a weather effect, but only 228,000 people, not an unusual number, were unable to work because of weather. So this is just really showing us weakness in the labor market. Now, the retail sales numbers that came out, they're a month delayed because of the shutdown. These were January numbers, but they weren't good either. Retail sales basically down 0.2 on a headline basis, driven down by a 0.9 drop in auto sales, all those cars under snow on the lots. Nobody went out to look. But the retail control number just up 0.3%. And across the board in retail sales, it was a fairly weak number. So this, Matt, I would say basically is a catch-up alert day at the White House, because you've got weak employment, and people have been afraid. We've seen this in the data about losing their jobs. And you've also got rising gasoline prices, and they're going up rapidly this morning. We're at the highest point for gasoline prices than we ever have been under a Trump presidency already. So he's got political problems in these bad numbers and what's going on with petroleum.
Right, and reportedly, there are times when the president throws condiments.
There are, yes.
So the interesting thing to me is looking through these charts, and I use the GIP charts on the Bloomberg to see what happened when the data crossed at 8:30 and then in the moments after that. Initially, futures bounced higher, probably on rate cut expectations, and you saw yields drop drastically. I mean, yields were up across the curve, and then they all fell far below the zero line. Now we see a reversal of that. Futures down sharply and yields back up. Look at the two-year yield here. Right now, adding almost a basis point to 358.33. So why do you think yields now are rising on this?
Well, it seems to be a status quo trade. We reacted immediately to where people were positioned going into the jobs report, and obviously this was a huge shock to everybody. And now you're getting back to the trade of we don't know what's going to happen, so we're just going to sit there. And I think that's what you'll see for a little bit while this is going on. And you mentioned rate cut. If you look at WIRP, the function on the Bloomberg, you'll see that there have been some moves toward pricing back in some rate cuts, but very little. Not what you normally see if you saw a number like 92,000, and that's because you got, on the other side, the inflation question coming from oil and other products that can't get through the Gulf.
All right, Mike, thanks very much. Michael McKee there talking to us about the jobs number that came in far lower than expected. The non-farm payrolls print, typically one of the most important economic data points that this market trades on. We're going to have more on the economy and jobs with White House National Economic Council Director Kevin Hassett, as well as Chicago Fed President Austan Goolsbee. They'll be joining us later this hour. Right now, though, I want to bring in BlackRock Chief Investment Officer of Global Fixed Income, Rieder. And Rick, your take first on the jobs number. What do you make of the U.S. economy now looking at 4.4% unemployment?
So it's interesting the way you phrased it. And thanks, Matt, for having me on. So I think the U.S. economy is doing fine. I actually think U.S. economy, I was just looking at the numbers before coming down here, I think we're going to grow 2.5% to 3% first quarter growth. the economy and employment are quite different conditions today. We have a productivity revolution. We talk about it. People were encouraged last month. You had 137,000 jobs last month, but 130,000 were in healthcare. You strip out healthcare, we have no hiring. So I looked at the next 9 months. If you strip out healthcare, the last 9 months, total jobs in the country is negative 358,000. Negative 358,000. Stripping out healthcare. We're going to keep hiring healthcare workers, even though today this number was a little bit softer. Again, last month was really strong. We're going to still hire healthcare workers because the population's aging. We looked at a metric, people 65 and above. We haven't even kept up with that rate of growth. A friend of mine was showing me that. So we're going to keep hiring healthcare. The problem is we're not hiring other people because there's productivity going on. And it's not AI hasn't really kicked in yet, but productivity. I mean, you see this. I read tons of earnings reports. You look at what companies are doing. Run your business more efficiently, keep your top line in a reasonable position, and get your cost infrastructure down. So point being, I think, by the way, economy's fine, and then, but it's just, for the people dynamic is harder, and it's part of why I believe you need to have more policy to help impact that.
It's interesting, Rick, I've been doing this for 25 years plus, and we always say the markets are not the economy, because there can be times when the people on Main Street are feeling pain and equity indexes are doing just fine. But what you're saying now is that jobs are not the economy, which is a little bit more concerning for those on Main Street.
I have a strong view that, there's a problem in that, what people describe as a K-shaped economy. I think we have a problem today in what are particularly routine-oriented jobs, low income, is having a really tough time today. The aggregate economy, because you actually got part of the economy, you got CapEx, and certainly data center infrastructure, et cetera. CapEx is in very solid shape. And then you got consumption that's being held up because you have a cohort that's actually still doing well, which is older, higher income. But we have what is a continuing and even a growing bifurcation that I think, and by the way, I think some of the initiatives you heard from the administration on affordability, things of that ilk will help. Listen, I think the Fed, I know we've talked about it before, you have a near-term dynamic around energy shock, a supply shock. I still think the Fed, I think we still have to get the mortgage rate down in this country to get labor mobility moving, to get housing moving. And so I think there's some initiatives to try and stabilize what, quite frankly, is a bit of a concerning dynamic today.
I talked a lot with Bruce Richards over the last couple of weeks. He sees an E-shaped economy because we know the top 20% is doing well. The bottom 40% are struggling. But he said we have a strong and growing middle class because of President Trump's initiatives to bring industrial jobs back to the U.S. I know we lost manufacturing jobs in 2025, and it looks like we lost manufacturing jobs again today. But there is so much confidence that the tax changes in the big, beautiful bill and the tariff policy, frankly, are going to bring jobs, manufacturing jobs back to the U.S. Rick, do you buy into that?
So I think some good initiatives out there. And I do think there are places that you will see in pharma, in chip manufacturing, chip production, et cetera, that I do think you'll see. And then, yes, some manufacturing I think will come back. Maybe I challenge a little bit that the middle is doing okay. I still think you have, particularly when you've got some prices moving up in some of these areas today in healthcare, education, insurance, obviously recently fuel. I still think the middle is, I wouldn't say the middle is doing great at all. So anyway, I still think you have that bifurcation. But yes, I believe some of these initiatives to stimulate, to buoy the economy in a bunch of different ways that are labor intensive. I mean, like I said, healthcare is a labor intensive industry. The good news is we have a demographic that will continue to instigate job growth there. If we can stimulate job growth in some of those other areas, no question that will be beneficial. I personally think housing is by far the most, because of the sheer size of it, because of what it does for labor mobility, because of what it does for people who can move, and we put people to work, a lot of people to work when we build houses in this country. So all those initiatives, I think, are quite welcome.
Rick, you are running fixed income at BlackRock, and we're looking at, with the exception of today, or maybe even right now, real yields kind of driving the move in nominal yields. I was talking to Cameron Kreese from our MLive team, and he points out that before today, the big gain that we'd seen in nominal yields was mostly taken out of or driven by real yields. And that we're not seeing a real sign from break-evens. How do you interpret that?
I mean, that was right up until, obviously, we've had this energy shock, and you are starting to see elevation in break-evens. Listen, I think, it's an interesting dynamic across, it depends on what part of the yield curve you're looking at today. Listen, I think these real rates are attractive, and I think, a question of we think about this today, we're in one of those modes now, even though I think the Fed could cut rates, has room to cut rates. I think you have to adjust you have to consider they're probably going to sit and wait for a while. So can you have some rate backup? So you have to manage around that. And, I think these real rates, if you take a longer term perspective and say, gosh, where are these real rates going? Where are nominal rates going? Boy, I think we're going to, and by the way, we just got a very, very, very strong reminder of productivity. Productivity will bring down wage pressure. Productivity will bring down inflation post, obviously, the energy shock. So I think we're going to a different place. Do you position for that today, or give it a few weeks to let the Mideast situation die down? But there's no question in my mind we're moving to a different place in terms of real rates, and nominal rates will come down, and break-evens will come down, obviously.
But if real rates continue to rise, or if we go back to that scenario, Rick, typically that's not a good sign. Is that sustainable? Because typically when real rates are rising is when things start to break, right?
They do. Yes and no. I think you can have some elevation. Listen, you got an economy that's actually operating away from the employment picture. You have an economy that's operating at a solid level today. I think you get to these points in time where you get higher real rates. I don't think there's a systemic problem today at all. I will say the place where, when that real rate elevates, particularly in the front end of the curve, the debt in the country is too big. And so part of why, when you think about if you're running policy, there is a very significant mechanism that you need to think about. If we keep that real rate too high, the sheer borrowing costs of the United States move up significantly. The only way we diffuse the debt in this country is the economy has to continue to operate at the solid level it's operating at, and we got to get the cost of that debt. You got to get the real rate down, and you got to get the cost of the debt down. And then that, by the way, that's the longer term benefits for the currency are tremendous. We get debate near term dollar strength or weakness, but that has got to be the most important dynamic over the next couple of years.
Rick, I'm going to get to the war as we round out the first week of war in Iran, and how markets are reacting to that, and how that's driving oil prices, and what that'll mean for inflation and growth in a moment. But because you are the CIO of fixed income at BlackRock, because you were in the running, widely reported to be in the running for the chairmanship at the Fed, because people on both sides of the aisle look to you for economic analysis, how can we be in a good place if GDP is rising with a strong economy, and yet we're not adding jobs? This brings up the whole sort of ghost GDP nightmare scenario that James von Gielen put into his Citrini research piece a couple of weeks ago. What happens if productivity rises without people doing that, driving that trend?
So it's a hard question. I think it's unequivocal that we're going to have productivity enhancements. Obviously the amount of CapEx will lead to productivity enhancement. There's no question about it. You're talking about cognitive, technology that replaces cognitive thinking in many ways. So we're going to have some productivity. It's part of why I'm a deep believer. The U.S. is the most flexible, innovative, ingenuity-rich economy in the world. These initiatives, you talked about some of them, but some of these initiatives that are labor-intensive or labor-accretive are unbelievably powerful. We talked about real estate, as you said, and manufacturing. As you said, technology orientation in the U.S., where you bring back some of that chip development, et cetera. Like those things all have to happen to mute what is an unequivocal condition that we're going to have productivity increase. But, good economy, but an efficient economy. But we've got things that will stabilize and improve the condition for workers and for people in the United States, I think is absolutely essential.
Let's talk about oil for a moment, because another thing that Bruce Richards was outlining for us at the Bloomberg Invest Conference this week, which I think makes a lot of sense, is that as the oil price rises, his expectations for growth come down. So he was saying 3%, like you, at $60, $65 a barrel. But as we get to 80, if we hold there sustainably or over, maybe only 2% growth. At $100 a barrel, maybe only 1% growth. And if we get to 120 or above, sustainably, that we could be in a recession. How do you view the effect of these oil prices on the U.S. economy?
You know, Matt, the reason why it's a great question is, you know, and you know, when you step back and think about when you have a supply shock, and you know, if you're setting policy, monetary policy, when you have a supply shock, the derivative impact of that is very clear. You dull growth significantly. It is, you know, I wouldn't have argued. I don't believe that there's that significant a drop-off per those numbers. I have to think about it a little bit more. I don't think it's that significant because we're still a service-oriented economy. 70% of the U.S. is services. We don't have that same manufacturing hard asset commodity transmission as you would have had in the past. But yes, I think you slow growth. I think it's unequivocal you slow growth. And if that's the case, that's part of why I believe monetary policy, and people say they should raise rates to combat this inflation. Actually, I couldn't disagree with that more. I actually, you know, if anything, I actually think you should cut. Will they do that? No, I don't think so. I think they'll sit and wait and see what the inflation transmission is. But that point about what happens, a derivative impact when you have a supply shock, is quite clear around the growth impact.
Rick, one of the other things that we pay very close attention, one of the other reasons we pay very close attention to what you say is the outperformance of the ETF that you run. And we show it a lot here on Bloomberg. BINC is the ticker BINC. But if we pull up a comp screen of that on the Bloomberg terminal, it's just undeniable that you're crushing your benchmark here. So what changes might you make, or what would you be considering with your holdings? And we can find that by typing BINC Equity DES and click on the Holdings tab. After this number, as we start to see, or if we start to see, the jobs picture weaken.
So, Adam, you know, and people can look at it, and you know, listen, when you have a shock like we've had, and you don't know the duration of the shock, and we talk about the impact it can have on trade and the uncertainty that it can have in the near term. I mean, you know, we start to cut beta, and you got to bring, you know, in an environment like this, particularly, you think about what does your interest rate exposure do for you? Well, if interest rate doesn't help you to manage the risk, you got to bring your risk down. And so we've been on a mode of let's pull some of the higher beta income down in the interim. And so can you run a little bit lower income in the short term because you're trying to manage to a total return paradigm? So a bit of that, you know, reduce some of the beta, a little bit of the credit, a little bit of the interest rate exposure, a little bit of mortgage exposure. Just, you know, can you, you know, quite frankly, this period you hunker down a little bit. But, you know, the big thing for us, the markets always react to the next 2 weeks, week to week. There's presenting some opportunities that we're looking in the securitization market, emerging markets, that, you know, even though we pull down a little bit of EM, it's like, gosh, you know, on the other side of this, where are we going? Because you know, the opportunity set's getting better. You just got to be a bit patient and then be tactical about where and when you step in.
Rick, great to get some time with you. Thanks very much for joining us on this Jobs Friday. BlackRock's CIO of Global Fixed Income, Rick Rieder. Now let's take a look at what's going on with markets. We've got about 10 minutes to go, 12 minutes to go until the opening bell, and we're looking at futures that are now down 1.33%. We were down before this jobs number came out, but we've moved lower. We did see yields drop across the curve, but they have now come back, I should say, to where they were trading before 8:30. So equity index futures off and yields trading right where they were before the number came out. You got crude as one of the biggest drivers that markets are watching right now, up 8% on Brent, on NYMEX, I should say. NYMEX crude, $87.85. That looks an awful lot like Brent. More reaction to the surprising jobs report with White House economic advisor Kevin Hassett, Chicago Fed President Austan Goolsbee, former Fed economist Julia Coronado, and strategist Emily Rowland at Manulife John Hancock Investments. We've got it all coming up for you on Bloomberg Open Interest, as well as an appearance with surveillance anchor and my buddy John Farrow. Definitely keep it tuned here. This is Bloomberg. The U.S. economy lost 92,000 jobs in the month. We are expecting to add more than 50,000, according to a survey of economists, and unemployment rose to 4.4%. As a result, the S&P futures are falling right now, 1.3%. Typically, this would be a bad news is good news scenario for equity investors because you'd expect Fed rate cuts. But the big problem is Brent crude, or really oil across the industry, the energy universe. Brent is over $90 a barrel now. You can see it trading there at $90.13. NYMEX crude is up to $87.84. When I read that, I actually thought that we had a mistake on the screen because it looks like higher than Brent was yesterday. So huge jumps across oil. This is, as Mike McKee was saying, the highest price at the pump since President Trump has been in office. And the war in the Middle East continues to drive disruption across energy markets, natural gas being no less of a problem than crude. Amos Hochstein, a former White House advisor, spoke about the crisis.
But understand between that and understanding why we're at war, and then you add a cost of energy prices, which goes to electricity and food and gasoline and a lot of other commodities throughout the economy. I think people say, am I willing to be able to pay for this? And there's going to have to be a way for the administration. It's going to have to explain and to demonstrate that it is either very temporary or that they'll be able to mitigate the cost for the American public.
Joining us now is Eric Nightingale. He helps lead Bloomberg's global oil coverage out of Europe. And, you know, we see such big spikes that I think at some points I'm misreading these numbers, Eric. I mean, $87, $88 for NYMEX crude, Brent over $90 a barrel. Why this leg up in concern, this leg up in alarm?
Well, I think the thing is that every day that goes past, you're getting new disruptions, and it means you're baking in a longer-term kind of recovery period from this conflict. The Strait of Hormuz has effectively been closed pretty much since the war began. Tankers are piling up outside waiting to get in and on the inside waiting to get out. And that's a huge problem. It just effectively means that the energy can't be exported. Production is having to cut back, and here we are.
So in terms of what energy traders are doing, Eric, why aren't they trying to price this all in earlier? Why are they adding, $5 a barrel each day? Is the idea that this could somehow, we could find an off-ramp and things could go back to normal in terms of price?
I mean, is the oil price really that high now? You're talking $90, sure, but, they have closed an avenue for a fifth of the world's crude oil and a fifth of the world's liquefied natural gas. Is it really that high? That's the issue. As this goes on, I think people maybe were hoping for a disruption, an end to the disruption, but when that doesn't happen, you start to see these issues, becoming obvious, the kind of loss of production in different countries, refineries closing, refineries having to cut back. This is a really, really, really serious issue. So, in some ways, the market has actually managed it quite well.
Eric, you have the best view of trading desks across Europe and the Middle East. Talk to us about the specific regions that this oil is destined for, the contracts that we need to be watching, because it's my understanding that although it's a fifth of the world's energy supply, a lot of it is headed to Asia.
That's right. So the vast majority of the Persian Gulf's oil does go to Asia, then the liquefied natural gas is more dispersed. But I don't think you have to worry too much about individual contracts. This is a global thing. You can't lose a fifth of the world's oil and a fifth of the world's liquefied natural gas and focus on one contract. This is going to disperse everywhere. That's why you've got jet fuel in some parts of the world that's above $200 a barrel. That's why you've seen diesel prices absolutely skyrocket. That's why, as you said, the price of gasoline is more expensive in the US than at any time during President Trump's office, either this one or the last one. So that's the issue.
Eric, thanks so much for your coverage. Eric Nightingale runs our oil team out of Europe. Less than 4 minutes until the opening bell. Kevin Hassett joins us next from the White House. This is Bloomberg Open Interest. We are moments away from the start of trading. We are looking at futures that are down pretty sharply after the jobs number missed by a mile. S&P futures off by 1.25%. The U.S. economy lost 92,000 jobs, including manufacturing jobs, in the month. We were expecting a gain of more than 50,000. NASDAQ futures down 1.5%. The small caps down more than 2%, which is interesting because normally this kind of job loss would spook the market into thinking, oh, we're going to get more Fed rate cuts or at least pull them forward, and that should be good for the small caps. That is not the case today. We saw yields come down and then spike back up to the levels that they were. Vlad Tenev, you'll recognize ringing the bell at the New York Stock Exchange. He's got an IPO of a fund that Robinhood is launching to trade shares in privately held companies. We'll talk about that because we're going to talk to him in just a moment. At the NASDAQ, you've got Minimed ringing the opening bell. But let's take a look at the move screen first of all. As the cash trade starts to populate, and it'll take a couple minutes for everything to come online, but right now only 66 stocks are up and almost 400 are down. Microsoft, ConocoPhillips, Netflix are gaining, but Nvidia is off 1.6% and Apple is down 1.4%. Let's take a look at the GLCO screen. Global commodity prices is what many traders have up on a permanent Bloomberg screen right now because the gas price is moving so severely. NYMEX crude is trading at more than $88 a barrel. That's West Texas Intermediate, folks. And Brent is up over $90 a barrel. There's real concern that as this war in the Gulf reaches the end of its first week, we're not going to be able to find an off-ramp quickly enough to bring these prices down. Let's bring now White House National Economic Council Director Kevin Hassett on with John Farrow from Bloomberg Surveillance. John?
Hey, Matt, appreciate it, buddy. Thank you for that. Live on TV and radio, I'm pleased to say that joining us now, following the jobs report, is the National Economic Council Director, Kevin Hassett. Kevin, you're a good man. Thanks for making time for us this morning. John. It's an obvious downside surprise on the jobs report. The three-month average has dropped to 6K. I think some people looking at this report at the headline level might be a bit nervous about what's inside it. Are there some one-offs here that make this look worse than maybe it is?
Yeah, there are a few. First of all, we had the crazy weather in February. The worst of it was actually outside of the survey week, but there was a lot of lingering junk, as you might recall, with the ice that was everywhere. We had some strikes on the West Coast that knocked off between 30 and 40,000 jobs. And so I think that on net, it's almost like a wash number. And the final thing is that there's a new procedure birth-death model at the BLS, which we believe is going to make the number more volatile. And so I think more and more we're going to have to average through the months. And remember, we had a really surprisingly positive number last month. And I think if you average the two, then it's about at the rate of job growth that's consistent with 3 or 4% GDP growth.
Kevin, it goes against the grain as well. ISM data earlier this week was really pretty decent. Claims were stable too. Next time we speak next month, do you expect to have a better story to tell?
Yeah, I think that right now what's going to happen, right, is that the variability in the data will be apparent to folks. And so what's going to happen, I think, is that there'll be some anxiety that another number like this or 2 or 3 numbers like this is ahead for us. But we really don't believe that because, as you and I have discussed, like every other indicator is consistent with very strong GDP growth right now. And so this really is an outlier number.
Tax refunds are a big part of the bull case for the U.S. economy. I've got the Bloomberg lighting up in front of me right now with energy prices surging. How those refunds are going to be spent is key, Kevin, with energy bills still climbing. What's your assessment of the disruption we're seeing to supply in the Middle East?
Well, our expectation is that we've got our eyes on the horizon, that we know that sometime soon we're going to have a much more stable Venezuela with high, stable energy output, a much more stable Iran with high and stable energy output, which is going to be very good not only for energy markets, but for risk premia around the world. Don't forget that this move against Iran is happening because they've promised to destroy us all. Like if that's not something that affects risk premium, I don't know what is. And so I think with an eye on the horizon, then you can see that this is a huge positive for the global economy and global markets. The question is, when will the current near-term disruption end? And that's something that'll be decided by the military. And of course, will be some uncertainty about when they decide to move, in part because the uncertainty protects the lives of American soldiers.
Kevin, in the meantime,
but we we expect that it'll be resolved, quite soon.
As you see, we're starting to see a hit to production. Because we can't move the oil, we're breaching storage capacity in select producers right now. You saw some of that with Iraq earlier this week. The Journal reporting moments ago, we're seeing the same thing in Kuwait, and UAE and Saudi Arabia might follow. That's obviously a bigger, more acute issue for the Asian refiners right now, which is why the Treasury Secretary came out and issued a waiver for the Indians to buy from Russia, the Russian crude that's offshore in tankers right now. But Kevin, I wonder what else the White House has got in store. Not just to tell people to wait, because in the future it will be better, but what are the remedies that you can produce right now?
Oh, sure. The sanction waiver that Secretary Bessent came out with is just one of many, many tools that we have ready. We've got a whole flow chart of tools to use depending on this or that, and we're ready to move them as soon as we have to. But we're also very optimistic that we're going to be able to get this near-term problem resolved relatively quickly.
The Biden administration, as you know, burnt through the SPR, took it down quite dramatically. Is there space left in the SPR to deploy some of that to bring down prices just a bit for consumers?
You know, there is no conversation right now to dip into that, but we've got something like 400 million barrels ready to go if needed. But there is, I re-emphasize, that there has not been a conversation to dip into that yet, because our expectation is that this effort in Iran is way ahead of schedule, and that we understand that there are near-term market fluctuations, but we have our eyes on the horizon, and we think that's where people should be looking to.
Kevin, you say ahead of schedule. Is there a schedule?
Yes, but obviously we're not going to go through the schedule on TV.
The timing of this is so important to people, though. They need to understand the duration, to understand how acute the problem will be. It feels very open-ended. It feels different to what we saw in Caracas. Tehran is not Caracas. Iran, as you know, is not Venezuela. Can you assure people this won't be something that goes on for months? This is something that will go on for weeks?
There's nobody that expects that we're going to have a disruption that is anything like what the bears right now fear.
Kevin, the president's also said there'll be naval escorts as well to help tankers get through the Strait of Hormuz. As we understand, tracking the traffic here at Bloomberg, that's grinded to an effective halt as of this morning. What can we do to help those tankers get through that strait, and how quickly can we do it?
This is a matter that is being studied very closely by the military and discussed constantly, and I expect a heck of a lot of progress was made in coming up with a plan that can do exactly what the president has suggested. There
were two dimensions to the president's suggestion, one with the naval escorts and the second piece was insurance. How long do you think it will take to put together something more comprehensive to give people the certainty that these things are insurable?
Well, I think it's really the insurance and the naval effort and the destruction of the Iranian assault capability. Those things are all on the table, and I think that markets will move forward quickly once it's clear that the U.S. military has resolved those matters.
Kevin, there's another aspect to the price action that's making some people nervous. I'd love your thoughts on it. It's not just the disruption that we're seeing in the Middle East and the disruption to energy supply. There's also issues in private credit. Every day there is a headline about redemptions and certain firms trying to meet redemptions in different ways. We've talked a lot about financial conditions, but are financial conditions tightening in a way that we can't see in private markets? And how are you tracking things?
Oh, we're tracking it very closely. We're keeping an eye on things that are liquid, things that are illiquid, and so on. And right now we see a very well-functioning market that's under a tiny little bit of stress, but for the most part, outside of the one firm that had the significant issue, it looks like everybody's in good shape. But we're following it very closely.
Kevin, how do you track those things? Are you in touch with the big firms right now about what they're doing? Are there certain blow-ups that are making you more concerned than other things? How do you track these things?
There are behaviors that make you concerned, like when you see a radical amount of shorting of assets of firms that are starting to feel some distress and so on. And we're seeing, and that's something that we really haven't seen since the financial crisis in 2008, and we're seeing nothing like that kind of activity.
Kevin, Lloyd Blank finds someone we both respect, said he sees echoes of what happened in the financial crisis. Jamie Dimon of JP Morgan has said some people have done some dumb things. Mark Rowan of Apollo has said something similar. Do you think people have done some dumb things that are going to come to the surface later this year?
I think people have made some bets that didn't pay off, but that's kind of what happens in financial markets, right? So whether it's dumb or not, ex ante, ex post, it looks dumb.
Does it pose a risk to all of us?
Excuse me?
Does it pose a risk to all of us? Is there a systemic aspect
to
some of this?
I believe that there's so much security in that space that they can handle the stress that we're observing right now.
Kevin Hassett, thanks for the update. We appreciate it, sir.
Thank you.
Thank you very much. The National Economic Council Director, Kevin Hassett there. Matt, you heard it from the man himself there. Clearly there are some issues that we need to get through right now, but it's going to take time. How much longer this is going to go on for, I've got absolutely no idea. But Matt, that's what's dictating the moves in energy, and that's what's dictating the moves elsewhere.
That's right. And he said he doesn't want to give us the schedule because he doesn't want to endanger the lives of American soldiers. It's very rare to hear that in an interview on non-farm payrolls day, as almost a defense for a number that was surprisingly low, a loss of 92,000 jobs when we were looking for a gain of 55,000. John Farrow from Bloomberg Surveillance, really appreciate you joining us for this interview. Let's get a check of what's going on in markets right now with futures down 1.5%. Futures. This is a cash trade for the last 10 minutes, down 1.5%. Right now, the level at 67.27 on the S&P, and I'm looking at messages from traders who say maybe we should just fold up shop until the S&P index hits its 200-day moving average at 65.82. Right now, it's really the crude price that's driving everything, and you continue to see it rise higher. NYMEX crude approaching, this is WTI, folks, $89 a barrel, with Brent well over 90. That is the driver of all of the angst in these equity markets. Joining me now is Elena Popina. She runs our U.S. equities team here on the Bloomberg News side, and we're ending our first week of war with Iran. So I wanted just to get a look at how equity markets have been responding. How has your team been reading these things?
Yeah, Matt, so far this week, up until Friday, there were no signs of outright panic. In fact, the S&P and the Dow and the Nasdaq changed direction every day so far this week. Traders have been trying to figure out what that means for the fundamentals longer term. We all know that geopolitical conflicts have historically presented good deep buying opportunities. Since the Cuban Missile Crisis, going back to 1962, the S&P has added 15% a year after major geopolitical events. So longer term, traders are not that concerned about fundamentals, with the big if of crude prices going up, with the big if of inflation expectations on the rise. We have an inflation report next week, and guess what? The break-even tips for inflation are starting to creep higher. That feeds into the broader anxiety we're seeing right now with the S&P and the Nasdaq down about 1.5% as we speak.
Yeah, I've been talking to the MLive team. They sit right across from your team, and they have been saying, real rates are driving these gains, but now we're starting to see the break-evens break out, if I may, and that's a real concern. You have seen some real turnarounds in equity trading, though. There will be days, the one day that we were down more than 2%, we actually closed higher. And that seems to happen every day.
Yeah, I mean, the markets are trading on geopolitical headlines, with the tape ticking every second. But what's actually happening right now beneath the surface is we have a big rotation out of global equities and into the U.S. Remember, for most of February, we saw the tape of traders going into global stocks. MSCI ex-US outperformed the S&P. The opposite is happening right now. In fact, this week through Thursday, US stocks are on track for the best week since global peers since April 2025. So there is a big rotation from global into the US. The S&P still provides some safe haven. And there is a second rotation going on with traders seeing companies with good balance sheets, good finances as a relative safe haven, because we did see some of the hesitation in the Max 7 trade for most of January and February. Right now, trading desks are saying, guess what? Maybe it's a good idea to go into those high quality stocks with high balance sheets, high capex opportunities. And now the Max 7 group is down 7.5% from a record high. Maybe it's a relative haven asset during volatile times like this.
Yeah, I was just looking at the equal weight S&P has been outperforming the price-weighted S&P all year long, and that has turned around in the last few sessions.
Yeah.
So those Mag 7 stocks are starting to become or get a real bid from investors in this market, and you see that going on under the surface, as well as a shift from the sell America trade.
Yeah.
We see the same thing happening with the dollar. We haven't really seen it with treasuries because of the concern about inflation, right?
Yeah, but the dollar is on track for the best week since 2022. So the relative strength of the dollar and the relative status of a safe haven asset that the U.S. Large cap companies have may make sure that the trade of going back into the U.S. into the high quality U.S. may continue. You look at the small caps, micro caps; they all plunging right now.
Had been outperforming and are now plunging.
Before Friday, the Nasdaq 100 though has been up for the week. The S&P was down, yes, equal weight S&P was down. Nasdaq 100 has been holding ground. Today is obviously an exception. We saw a very concerning headlines about Iran, about a rise in crude oil prices. But let's see what happens next week. We have a few very important economic announcements, with the CPI being the major one.
And a ton of Fed speakers today as well. As your team talks to investors, what are people saying about the Federal Reserve? Because we had been expecting a number of cuts until we saw these increases in the price of oil, and now it looks like inflation is the main driver of concerns for the equity market, and as well maybe for Fed speakers we're going to talk to today.
Yeah, I mean the Federal Reserve is in this catch-22 type of situation where they really need to go by what the data show and what the economic announcements show, because we don't know what the price of crude is. JP Morgan was out with an announcement that it can reach up to $125 per barrel. That would mean a very different economic environment than where crude is trading right now and where crude has been trading. So it's a very tough situation for the Federal Reserve at this point.
Elena, thanks so much for joining us. Elena Popina runs our U.S. equities team on the BN side. Catch-22, by the way, my second favorite fictional book by James Heller. If you haven't read it, I highly, highly recommend it. Coming up, how will the Middle East war impact inflation and therefore interest rates? These are the questions that we have been asking all week, and these are the questions that Mike McKee is going to put to Chicago Fed President Austan Goolsbee next. This is Bloomberg. Let's turn now to Bloomberg's Michael McKee with Chicago Fed President Austan Goolsbee. Mike?
Welcome back to Bloomberg Radio and Television viewers and listeners around the world. Our guest this morning now, Austan Goolsbee, the president of the Chicago Federal Reserve. And of course, everybody wants to know what the Fed's going to do. The Fed's worried about jobs, and today you had a number to worry about.
Yeah, it's a tough miss on the jobs report today. You never want to over-index on 1 month's report, and I've been consistently saying, let's not index on total payroll employment anyway, because a lot of stuff is going on with immigration, with population growth. That said, you saw the unemployment rate inching up, and it's 1 month. It's not a trend, but it's not a good month. If you got several months like that, that'd be a concerning spot for the labor market.
Well, what's your feeling about what the Open Market Committee is going to do? I know you've been waiting to see data. Chris Waller has been saying he's still in favor of cutting, as is Stephen Myron. Where do you come down now?
Well, as you know, and I appreciate you asked it that way, I'm not allowed to speak for the committee or for anybody else, just myself. I've been saying for some months that we've had relative steadiness in the job market, in my view. The strongest thing in the economy is not AI data center investment, has been consumer spending being solid in a kind of a broad-based way in the economy. But the inflation hasn't been ideal. It's at least stalled out at kind of 3%. And some of the latest measures, the inflation disturbingly high in non-tariff categories like services. I think we're still basically in that same spot. I remain hopeful / expecting that conditions will improve, that we'll start to see some progress on inflation, head us back to 2%, and by the end of this year, that we would be in a situation that we could commence our march back down to something like the settling point, which is below where we are today. But each time we add an uncertainty, I think the job market characterized by low hiring simultaneously with low layoffs is a weird combination. And when I talk to business people out in the Midwest, they characterize it because of the uncertainty. So as we get more uncertainties, I kind of think the time at which it makes sense to act keeps getting pushed back. I always say the first rule of the data dogs is to recognize there's a time for sniffing and there's a time for walking. And when there's uncertainty and you're getting conflicting data points, that's the time for sniffing.
I'm sure everyone out there is very glad to hear you bring back the data dogs. It's been a while since we've heard that. Speaking of data dogs, one dog that is barking very loudly right now is oil prices, but the Fed tends to look through that.
Yes. I mean, as with any supply side shock, it can lead you in a stagflationary direction, which is to say the inflation side of the mandate getting worse at the same time the employment side of the mandate is getting worse. And that's always the worst case scenario for the central bank, because there's not an obvious monetary policy answer to a stagflationary shock. Oil prices going up, we need to think about, is this a transitory thing that's going to be temporary? Is this going to be long-lived? How big will it be? How long will it last? And how is it affecting the supply chain before we can really say anything about it?
I would assume that you would assume that March 18th is not going to see any kind of rate move because there's still too much uncertainty. Do you think you would have enough data by April to even make a decision one way or another?
You know that I don't like, and you assume that I assume. I don't know.
What would a data dog do?
You know, I don't like tying our hands ahead of the meetings. I want to hear what my colleagues have to say. I want to get as much information as possible, especially at moments like this where we're getting conflicting pieces of information. But you've been there. It's the biggest table that I've ever seen in my life in that FOMC room. So there's plenty of room for everything to be on the table at every meeting. So I'm not going to rule anything out.
We are, from the data that we already have, and other Fed officials have said this, expecting a bad PCE number. Are you still thinking of that PCE inflation as residual tariff as opposed to an underlying fundamental problem with inflation?
Maybe a little of both. I mean, that's why I've been uncertain and highlighting the inflation numbers. There's been some encouraging signs in inflation. Housing inflation has come down a lot and is likely to continue to come down. We had the run-up of goods inflation. That, I think a lot of it is tied to tariffs, and we're still trying to sort out, is there more to come, or is that basically all there was with tariffs and then it'll go away? But there's also been a kind of a disturbing persistence of services inflation, which I don't think you can attribute to tariffs because the tariff content of the services industry is not very high. So we'll have to see what the PCE number says. The Open Market Committee has said we watch PCE inflation. That's in our framework review. That's the best measure that we have of inflation, I think. And if it comes in hot and it's just goods, I would be more comfortable saying that looks more like a tariff-driven thing, and that's the optimist case, maybe, that it would prove transitory. If it comes in hot, but it's heavily on healthcare, a bunch of service sector industries, that's a different kettle of fish, and that's a little more, feels a little more persistent.
A sentiment question, the sentiment you get not just from CEOs, but also from just talking to regular people in your district. You've got a situation where people are seeing gas prices go up and up and up. And now you have a really bad employment report at a time when people have already said they're worried about losing their jobs. Are you concerned that this could tip us into the stagflationary environment? I don't want to say recession yet, but could cause people to pull back?
It might cause people to pull back. The last 5 to 8 years, however, there's been a breaking of the link between consumer sentiment and actual consumer spending. For some reasons we understand and some reasons we don't understand. So if you saw deterioration of consumer sentiment as, say, gas prices go up, which historically when gas prices go up, consumer sentiment goes down. If that did not translate into a slowing of consumer spending, I would be much less nervous. As I've highlighted, in 2025, the strongest thing that we have going for us was not AI data center investment. Yeah, that was great, but the main thing driving growth was a strong, stable consumer, broad-based spending, which drove growth in the country. And that still continues until it doesn't. So if sentiment deteriorated, and there's a lot of concern as I'm going around the Midwest and the Chicago Fed district, a lot of expression of concern about affordability, about costs on both the business side and the consumer side. If people begin to be nervous about their employment, historically that tends to show up as they're trying to build a little precautionary buffer, so the savings rate would start to rise. That'd be a thing to watch out for.
Let's end on a little bit of a positive note here. Productivity down from the third quarter, but still 2.8% for the fourth quarter. That's got to be something that makes you feel a little bit better.
Yeah, all of our inner economists are getting a little bit of a warm glow. Productivity growth is what makes us rich. Incomes can go up. Wages can grow faster without inflation if productivity growth is going to remain high like this. So I don't think that the adoption of AI has been big enough to explain that number completely. So I think there actually might be even some more running room to go with the productivity.
Austan Goolsbee, thank you very much. We'll have you back and have a Name the Data Dogs contest or something like that. President of the Chicago Fed. We'll send it back to you.
All right. Thanks very much, Chicago Fed President Austan Goolsbee and Bloomberg Policy and Economics correspondent Michael McKee. Now let's get a check on what's going on in the markets after a very disappointing jobs number, to say the least. You have a drop of 1.5% on the S&P 500. The Nasdaq not doing quite as poorly, maybe because investors think they need to seek the safety of Mag 7 stocks. We had a drop of 92,000 jobs in the month. We were looking for 55,000, a gain of 55,000. Unemployment rose to 4.4%, and that coupled with the rise in crude prices, which is really driving inflation fears, is no bueno for these markets. You can see NYMEX crude trading at $88.40, Brent well over $90 a barrel right now. This as President Trump puts out another tweet. He says no deal with Iran short of what he calls an unconditional surrender. Let's get the latest now from Michelle Jamrisco in Washington, D.C. She's Bloomberg's White House and national security editor. And Michelle, I will say that, when we started to see crude spike again today, traders immediately forwarded me this post and said this doesn't bode well for an off-ramp.
Right. Well, Matt, there's no telling where this is going to go. It does seem to keep escalating now in the seventh day with no end in sight. The timeline keeps getting murkier. And yes, those statements do kind of jolt the markets. I think, Friday tends to be a day where, the president likes to make news, own the news cycle into the weekend. So we'll see where the day takes us. We obviously have a big meeting this afternoon at the White House with defense contractors, the big primes. So maybe that's another opportunity for him to massage the message. But the morning's data don't look good, and the morning's messages don't look good for a sort of calming of the markets today around the Iran war.
Michelle, we heard President Trump give a summary of how well the U.S. is doing or how hard we have hit Iran. I think he said 60 to 65% of their munitions and missile launchers are down. How much longer, from the White House's point of view, can they keep this up?
Well, we do keep hearing, Matt, the amount of attacks and the amount of weapons that have been used and what has been destroyed. But the truth is, all the analysts, all the politicians, everyone looking at this is saying, there's no telling how much more is ahead, how much more has to be accomplished before we can say mission accomplished. And of course, they're wary of treading, I had a slip up there. I said a rock earlier. They're wary of treading the same lines that previous administrations have in terms of trying to end a conflict before it's actually ended. So, it's a really murky waters right now. And we'll just have to see, how much can be done from the White House's side to kind of reassure that there are enough weapons. This is a key debate today, that there are enough weapons in the U.S. stockpiles to keep this going for longer and to finish the job, hopefully in short order. And that's just not something that can be said with any certainty at this point.
Can we safely say, mission accomplished presumes that we know the mission, right? Can we safely say it's nothing short of a total regime change? Because I believe the president also said, in terms of a new supreme leader, that the Ayatollah's son or the former Ayatollah's grandson, neither one would be suitable, because we want someone completely different.
Yeah, this is something that's also been a moving target. I think the White House at times has been reticent to use the phrase regime change. It obviously has a lot of connotations for folks, especially in their base, who don't want to get involved in these regime change wars, these forever wars. But the truth is, President himself has talked about wanting a complete regime change, calling on the people of Iran to rise up, even, the Kurds and some other groups that might sort of affect that change. But, Trump himself has said there's no certainty who could come next. The other day he said it could be someone that's just the same as the old guard. So that wasn't really reassuring to those who want to see a clean end to this war and want to see that mission, that part of the mission, accomplished in terms of having a friendlier regime in place, which is, some would say a low bar after the Ayatollah's death, but there really is no clarity, and especially from the Iran side, who they might install as the new supreme leader. So we're a far ways from seeing, who might come to the leadership for, even as the attacks escalate on Iran and from Iran on all sides.
All right, Michelle, thanks so much for your contribution there. Michelle Jamrisco runs our national security reporting out of Washington, D.C. Let's turn back to the other big story this morning. It's National Economic Council Director Kevin Hassett weighing in on the weaker than expected payrolls report.
On net, it's almost like a wash number. There's a new procedure birth-death model at the BLS, which we believe is going to make the number more volatile. And so I think more and more we're going to have to average through the months. And remember, we had a really surprisingly positive number last month. And I think if you average the two, then it's about at the rate of job growth that's consistent with 3 or 4% GDP growth.
All right, to be clear, that wash number, a drop of 92,000 jobs. We were looking for a gain of 55,000. Unemployment now at 4.4%. With that said, let's get into our roundtable here. Julia Coronado, former Fed economist who now runs Macro Policy Perspectives, alongside Emily Rowland, co-chief investment strategist at Manulife, John Hancock Investments. Julia, I'll start with you on the economic side. And I had a really interesting conversation with Rieder at BlackRock this morning. He said the economy's doing great. We're just not adding any jobs. Can those two things be so easily separated?
No, not so easily separated. I mean, I think it's fair to take the average. If we average job gains over the last 3 months, they're at +6. Over the last 6 months, it's -1. But at the same time, over the last 6 months, the unemployment rate's been steady at 4.4%. It's gone down a little bit, it's gone up a little bit. But that tells us that we are in a very low labor supply environment. That was a choice. That's restrictive immigration. That's an aging population. We just don't have any growth in the population in the labor force. And so there's nobody to hire. They're still churning. There's still people changing jobs every month. This isn't a falling off the cliff report. It looks like a lot of noise between January and February, but it does leave a lot of questions for how the consumer is going to be spending in 2026. We know that the wealth effect supported a lot of spending in 2025. Are you going to get those continued gains in this volatile environment? Maybe not. Maybe consumers do get a bit more cautious. So it's a report that suggests, I think, maybe a bit more fragility than the prior data flow had suggested. There's a lot of optimism in baseline forecasts coming into the year, and I think there's probably a lot more risks around that forecast.
Emily, let me get to you for the market side of this, because traders seemed a little jumpy this morning when we initially got the number. Futures started to recover and yields dropped across the curve. Investors piling in to treasuries. That reversed very quickly, and now we're seeing the 10-year yield getting back up towards 420. How do you invest on this number?
Yeah, bonds are all over the place this morning, frankly. And, seeing this back up in bond yields, there's clearly a focus on oil prices and inflation. We're seeing really breathtaking moves in the oil market with prices up about 10% just today. So there is a strong smell of stagflation in the air right now, a negative 92,000 jobs report. It's bad news is bad news for the market. And on top of it, we have, again, these fears of inflation picking up here. This is really going to make things very, very tricky for the Fed here. We still, from an investment standpoint, the kind of bright side to the backup in bond yields is that we have income now. And that's something that we're very much focused on. And we would suggest leaning into that today.
Julia, what can the Fed do? I mean, if we're growing at 3%, if productivity is soaring, but we're adding 0 jobs, and we're looking at a rise in the price at the pump, how can the Fed make policy?
Well, I think this is a lot more of the wait and see approach. Bottom line, I think we expect PCE inflation to come in a lot hotter than CPI inflation. That's going to be a problem for the Fed. That's going to keep inflation from making much progress at all this year. Towards their 2% target. At the same time, you've got a labor market that looks, not falling off a cliff, but maybe a little wobbly and fragile. You already gave some insurance last year, and they will hope that will provide some support to the economy. But it's a precarious picture. But unless and until there is something much more worrisome than even today's jobs number, again, because it came on the heels of a very strong number. Unless you see the unemployment rate rising or a really sustained and significant contraction in financial conditions, I think this is just a lot more wait and see. I don't see how they're going to be able to put rate cuts on the table with inflation where it is.
How important is that to markets, Emily, to equity markets specifically, that we get more cuts? Or are we fine with a wait and see approach from the Fed?
No, we think it's very important. And, the bond market now is pricing in only 1 cut for this year, given these inflation concerns. It is wild to think about the fact that we now have 6 negative jobs reports and the bond market's pricing in 1 cut. This is not a healthy environment. Typically, with growth slowing like this as it relates to the labor market, the Fed would be looking to loosen monetary policy, and we're just not seeing that right now. So from an investment standpoint, we wouldn't be too overly concerned that this is 2022 all over again. There's a lot of differences. And remember, 2022 is the worst year in really modern history for a balanced portfolio. And so we want to be mindful about that. And, we don't have wage growth at 5 to 6%. We don't have this massive mismatch between supply and demand with supply chain concerns on top of explosive sort of revenge spending post-COVID. We don't have an elevated quit rate. People were very easily leaving their job to go make more money somewhere else back in 2022. And frankly, the quit rate now is at a cycle low. So there are a number of differences in our view that, we don't think bonds are going to get absolutely cratered here. The Fed was raising rates really aggressively then back in 2022. Now we're probably sitting here for a while, as Julia mentioned, sort of a wait and see period with the Fed on hold. So we do think the elevated income that's now available in bonds versus what was available then with the 10-year Treasury yield in the 1 to 2% range, now we're above 4%. Again, that's a good story for investors that are looking for income. And we would suggest locking in the elevated income that's available and building a return stream that can last clients for years.
Julia, what are the actual mechanics of this jobs market? John Farrell on Surveillance earlier said maybe this is employers kind of getting revenge for the quiet quitting that we saw post-COVID. But it's odd to me that we have economic growth, that we have incredible earnings growth, and we have no immigration, the labor pool is shrinking, and yet we're not looking at a talent war. Why don't companies have to be hiring workers or at least doing all that they can to hold on to them? And I think about that because Emily points out we don't see the wage growth that you might expect.
Well, because I think the growth that we're seeing is extremely narrowly concentrated. It's pretty much everything tied to AI. There's investment, there's profits. For most sectors, I think the profit story came from cutting labor costs. People talk about investing in AI and that they hope that will mean they don't have to hire more workers going forward. I think that's mostly perspective. The reality on the ground is we had something coming out of 2022 that we called labor hoarding, where companies held on to workers that they didn't necessarily need to be positioned for growth. Labor hoarding ended last year. Nobody's holding on to any excess employees. We saw companies across most sectors get very, very conservative in their labor force management. And so I think that was how they held on to the margins last year. Positive surprise, but can they repeat that this year when no consumers are really spending in a robust way? When we look at earnings reports, we see more of the same, more caution. We rely on this positive feedback loop between job creation and spending. That's kind of ground to a halt. So who's going to pay for the AI? What's going to drive the next wave of revenue growth? I think that's a much more open question than is reflected maybe even in the guidance that we're getting. I think companies are very optimistic, but it's all, that all has to materialize, and the labor market just isn't showing very robust dynamics.
Emily, are investors betting on companies being able to use AI to reduce headcounts, to cut costs, and to continue at the same level of margin? Because that's been a question, especially since the Citrini research note came out a couple weeks ago.
Exactly. And they are, but what we look at really is the earnings. Over time, we're strong believers that stock prices follow profits. And when it comes to the software sector specifically, the fear has really gotten ahead of the fundamental facts. And software companies just produced about 30% year-over-year earnings growth. We look at them as being oversold. Yes, there's going to be winners and losers in this environment as it relates to all sectors. But we want to think about technology stocks in the United States as having the best earnings growth prospects of any company globally. They're actually cheaper than they were. We were making references back to 2022. U.S. growth index, the U.S. growth index is actually 13% cheaper than it was back then. Meanwhile, international stocks, which has just seen this massive bid amid sentiment, technical momentums, are actually trading more expensive. So we would look to U.S. high-quality stocks, which have cheapened up in this environment, again, for those solid earnings growth prospects. They're high quality. They've got great return on equity, strong balance sheets, and still continue to pivot there in terms of opportunities, in addition to areas that are more defensive, like infrastructure and utilities.
Julia, let me ask you about your take on oil prices versus GDP, because Bruce Richards of Marathon Asset Management at the Invest Conference told me that, at $60, $65, he sees us growing at 3%. But when it gets above 80, if it's sustained, maybe that's only 2% growth. And at 100, only 1. At 120, a recession. How do you view that relationship?
Well, it's a much more complex picture now than it used to be, because let's keep in mind we have a very significant energy sector now. So yes, this is going to hurt consumers. It's going to hurt their purchasing power. It's going to, all else equal, make them a little bit more cautious. I agree that there are these threshold effects. If consumers will sort of look through a modest gain in gas prices, if it's big and sustained, they start getting more cautious on other kinds of spending. But then at the same time, the higher we go on oil prices in a sustained way, the more likely we're going to start to see drilling activity ramping back up. It was ramping down last year because prices were so low. So we could see the energy sector kick back in and start a bit more production, a bit more investment, and that, can offset from a top line GDP perspective some of the pain we're likely to see in the consumer sector.
It's so interesting. As a car guy, you know, after over a year of EV backlash, now we're going to start driving prices at the pump higher. Julia Coronado of Macro Policy Perspectives and Emily Rowland of Manulife, John Hancock Investments, thanks very much for your time. Coming up, a crypto measure from the SEC is under review by the White House. We have SEC Commissioner Mark Uyeda joining us next to discuss. This is Bloomberg Open Interest. A crypto measure from the SEC is currently under review by the White House, according to a notice posted earlier this week. An SEC spokesperson saying in a statement the regulator will consider interpretive guidance around token taxonomy for crypto assets in line with market structure legislation. SEC Commissioner Mark Uyeda joins us now to talk about this. And, you know, it's interesting that you even submit these things to the White House. Is this a new way that the SEC does business? Aren't you an independent board?
It's actually the way we've always done things. And I've been at the SEC for 20 years. It has always been this way. You know, one of the most important things that the White House does is whenever one agency does a rulemaking, there's an interagency process. So, I mean, you might think this is a matter of good common sense government, but the rest of government knows that if we're doing something that might affect their area, that they are alerted to it. So this is a process that's been ongoing for a long time. President Trump has reemphasized that the White House is going to make sure that all of the bodies that are accountable to the president make sure that we're submitting it and has a chance for White House review.
Is there increased concern around crypto now that we see what's going on in first Venezuela and then Iran, that people could be using these tokens to commit crimes?
Well, we've had that issue for a long time. And in fact, many of the people involved in crypto have long registered as money transmitters and have been subject to the AML and suspicious activity reporting requirements. Now we're talking about a whole different layer of potential regulation if it is a security or it falls outside of our jurisdiction. This is something that I've been calling for years. I thought we should have done this starting with the Biden administration. It was unfortunate we did not. So what Chairman Atkins has done is we are now trying to make up for lost time. And the most important issue, I think, is whether or not a particular crypto asset is a security or is it not? Because if it's not a security, we lose our jurisdictional responsibility for that instrument.
Well, is not this a case of like, if you're a hammer, everything's a nail? Like, you must surely think it's a security, right? And you've been thinking about it for long enough to have made a decision.
Well, each crypto has different attributes. Right. And we've got this 1946 Supreme Court case.
So Bitcoin is different from Ether, is different from Ripple, et cetera.
That's right. They can be. And we have, plus the thousands of other, or probably even tens of thousands of other instruments out there. What we've been lacking is clear guidance as, are you a security or are you not? We've got this 1946 Supreme Court case. One of the types of instruments that is a security is an investment contract. And that the Supreme Court said, if it involves an investment of money in a common enterprise with the expectation of profits from the efforts of others. So what does that mean with crypto? What does it mean when you have a decentralized apparatus that is behind it? So what we're trying to do now is to provide SEC-adopted guidance. And this is something that Chairman Atkins has called for. It's something that both myself and my fellow commissioner, Hester Peirce, have called for years when we were in the minority on the commission. Because it's not fair to try and bring enforcement actions against people if they don't even know that they've crossed the line.
So when do you think we're going to get back the White House review, and then when will this be made public?
Well, we're hoping to get this on as quick of a timeline as possible, but part of this is we want to make sure, and the White House wants to make sure that we're doing everything right, that we've considered all of the options out there. We have a process. We've conducted multiple roundtables last year. We've received hundreds of comment letters on this issue. And so now the White House is reviewing the end product of all of our work.
You mentioned you've been there for 20 years. Most of that time, I imagine you've had 5 commissioners, right? And typically you have 3 members of the party that is currently in the administration and 2 members of the opposition, so to speak. You now have only 3 Republican commissioners, and isn't Hester Peirce, her term is expired and she'll be stepping down, so you won't even have a quorum. How do you deal with that kind of, I mean, it's not good governance.
Yeah. Well, we'll have a quorum no matter how many commissioners there are. You can even, in fact, back in the 1990s, at one point, there were only 2 commissioners of the same party during the Clinton administration. For a good chunk of the time when I was counsel to then Commissioner Michael Pivovar, there were only 3 members of the commission. Mary Jo White, the former U.S. attorney here in New York for the Southern District, was our chair, and then Commissioner Kara Stein was the other. So this is not unusual to have vacancies on the commission. The important part is the things that we do we're subject to the Government of the Sunshine Act. So the 3 of us, if we get together, we have to do it in an open forum. We have to let the public see it. And so I don't see that interfering in anything that the commission does going forward.
Mark, it's been great having you on. You're always so forthcoming. I really appreciate your intel. Thank you very much. Mark Ueda there, SEC Commissioner. Coming up, Robinhood opens up private markets to retail investors with a new fund that will be trading today for the first day on the New York Stock Exchange. The CEO, Vlad Tenev, joins us next to talk about that. This is Bloomberg Open Interest. As we go to break, let's take a look at what's going on in markets. We have S&P down just a little bit more than 1% now, NASDAQ off a little bit less than that, and the small caps taking the biggest hit as oil absolutely soars. NYMEX crude getting close to $90 a barrel, and Brent crude is well over that level. This is Bloomberg. Let's get a look at what's going on. You can see here the S&P down 1.2%, and the NASDAQ down less as investors maybe reach for the perceived security, not of treasuries, but of Mag 7 stocks. That has been the move, according to Elena Popina. She runs our equities coverage on the BN side. And if you take a look at the breakdown on the S&P.com, you do see some of the big tech stocks losing today. Apple is down, Nvidia is down, Amazon's down, Facebook is down, Tesla is down. So it's not happening today, but maybe they're not off to the extent that they otherwise would be. The real screen that traders and investors have up and is going to burn an image into their Bloombergs is oils. You can see Brent right now up 7%, $91.43 a barrel, and NYMEX crude, West Texas Intermediate, up almost 10% at over $89 a barrel. This is driving everything in the markets. This is the reason that even with a jobs loss of 92,000, and we got that for non-farm payrolls this morning, we were looking for a gain of 55,000, even with unemployment rising to 4.4%, you don't see expectations increase that the Federal Reserve is going to cut rates because they have to be more worried, more vigilant about inflation. With prices rising at the barrel level, we're seeing prices rise at the pump to the highest level in President Trump's in his time in office. In both terms, he's never seen gas prices at the pump this high, and that has got to be a concern for the Fed as well. Let's get to markets, though. We still have day-to-day business obviously continuing, and Robinhood is giving retail investors access to coveted private companies such as AI software firm Databricks, smart ring maker Aura, for example. Shares of a new fund that Robinhood is trading are set to begin on the New York Stock Exchange under the ticker symbol RVI. It's trading now. Vlad Tenev, the chairman and CEO of Robinhood, joins us to talk a little bit about this product after ringing the bell this morning at the NYSE. Vlad, thanks so much for joining us. Tell us, first of all, why the NYSE and why this fund? What's in it and what are you doing with it?
Thank you for having me. So the purpose of Robinhood Ventures is not just to open access to private markets, but to completely blow the doors off the hinges so that they can never be closed again. We think that it's a big iniquity in capital markets that you have companies staying private at valuations in the hundreds of billions, and retail investors get shut out. So Robinhood Ventures is a closed-end fund listed on the NYSE that invests in private companies. The idea is we raise the capital in an IPO, and then we invest that capital in private companies. And so far, we've got a portfolio of frontier names in their industries. You mentioned Databricks, Aura, Mercor, Revolut, Ramp. Those are just some of the companies that are part of this portfolio, and it's just the beginning.
I'm just curious about the NYSE as a vendor. The primary exchange for your stock is the NASDAQ. Why do you choose the ICE exchange there?
Yeah, I mean, we, like you mentioned, we went public with Robinhood Markets on the NASDAQ, and we thought we would give NYSE a try because they have a long history of closed-end funds, which this is, listing on the exchange. And it's fun. The history of the Buttonwood Agreement signed outside here is very much one of the birthplaces of capital markets. So we're excited to be a NYSE member.
How do you? I mean, the mechanics of trading private companies means you have to either buy into it at the I guess VC level, or you have to buy in the secondary market from employees and other shareholders. How do you do that?
Yeah, so we've got an investment team. We're out there in Silicon Valley, banging on doors, meeting with companies. We're kind of in an interesting place because I think Robinhood is perhaps the only brokerage that has roots in Silicon Valley, and we're still actually close to the companies at the epicenter of innovation. Yet we also have 27 million retail customers. So I don't really think this type of product has been possible until now at this scale.
Democratization, I mean, kind of the reason that you cite for this, Vlad, it's at the core of Robinhood DNA, and I'm wondering if it's going to drive more products, or if you can tell us about other products that are aimed in the same direction.
I mean, this is like, we view this as the next front in our mission to democratize finance for all. We're working to democratize private markets, and it's certainly not going to be done in one shot, right? This is going to be a long process. And I see a future where it's not just late stage companies, but companies at seed stage and Series A have retail investors as a substantial component of their shareholder base. If you think about what's happening now with AI, I think one of the big tragedies is that AI companies, many of the leading ones, are private at valuations in the high hundreds of billions. And that upside up until now has largely gone to a smaller and smaller group of insiders, wealthy insiders that just keep getting wealthier. So there's not much we can do about the past, but our focus is on the future. And I think this is a first step in changing things for the better.
You're looking at companies that are now really, as you mentioned, in the heart of excitement over investing. Massive valuations like OpenAI or like SpaceX that could come to the public market. What happens when they start trading in an IPO? Then you, I guess, effectively cash out the closed-end fund investors?
Yeah, so the fund would have flexibility to hold, buy more, or sell. We have the ability to keep holding. I think we would think about any event as an opportunity to re-underwrite the companies. And I think the value prop for companies that are part of the Robinhood Ventures portfolio is that nobody else can connect them to the retail audience in quite the same way. So we don't have conventional LPs in the same way that a venture capital fund would, and there's no carry to the fund. So we believe that it's a differentiated product, not just for retail, but also for the company side as well.
Vlad, can you just tell us, as we get to the end here, a little bit about the trading activity that you've seen on your platform? You have an incredible bird's eye view of what the retail investors are doing throughout this first week of war in Iran, as we see an incredible spike in the price of oil. What's your take on the equity trading activity on your platform?
Yeah, customer activity has continued to be strong. Trading activity is robust across a wide variety of names. And of course, we now offer a suite of active trader products that allows people to trade energies and metals. So you have our futures trading market offerings. You have Robinhood Legend, which is our active trader platform on web. And so customers have continued to be active, and you have a good mix of active traders as well as folks that are just seeing opportunities out there, and maybe they're not going in and out and taking multiple round trips, but they see it as an opportunity to keep growing their positions. So yeah, we've seen, we've gone through many ups and downs in the market, many geopolitical events, and the retail customers in our community who tend to be a little bit younger, continue to take opportunities, look for them wherever they may be.
Vlad, great to get some time with you. Really appreciate it. Vlad Tenev there, the chairman and CEO of Robinhood, coming from the floor of the New York Stock Exchange. Their closed-end fund, RVI, is currently trading, and you can see the shares at $22.30 apiece. Coming up, President Trump says he doesn't want to negotiate an end to the war with Iran, demanding now that Tehran capitulate totally. We'll head to Washington next for the details. This is Bloomberg Open Interest. Let's take a look at what's ahead for markets next week. On Tuesday, existing home sales and earnings from Kohl's come out. Wednesday, U.S. CPI data rolls out. Thursday, we get another round of jobless claims, plus more retail earnings from Dick's Sporting Goods, Dollar General, and Ulta Beauty. Finally, on Friday, you get the core PCE number and University of Michigan sentiment, as well as JOLT. So Friday will be a spicy day for the economic data. But of course, it's the oil price right now that's moving everything. And let's get over to Nathan Dean about it of Bloomberg Intelligence, because every Friday he breaks down the key events in Washington, how policy is shaping industries and companies, and the catalyst investors need to watch. And Nathan, it seems like there's one major catalyst right now, one major event, one major piece of policy. Is the U.S. going to give us is the administration going to give us any kind of timeline for this war, or is that counter to good strategy?
So I don't think you're going to see anything in the words of a timeline. President Trump even just said this morning that, he would rate the military effort a 12 or 15 out of 10. But you are going to see Congress try and start debating this idea of a supplemental defense bill. Now, Bloomberg News reported that there's going to be about $50 billion that the Pentagon is asking for. And the reason why it's important for clients is because anytime you get something out there to the floor, like a supplemental defense bill, everybody else is going to try and attach something to it. For example, we even heard that $15 billion worth of farmer aid could be attached to this. And if this thing begins to blow up, and we even see the White House come out and say, look, instead of $50 billion, we want $500 billion, then obviously this could be something that's going to be dramatically important for companies and sectors out here. But we just tell folks that, the smaller it is, the easier it is to get past. The bigger it is, it's going to fall bigger to political games, and it's going to struggle.
What are we seeing in terms of policy? I mean, affordability is a term that President Trump both, I guess, hates and also embraces, right? But the price at the pump is very important to him in terms of gasoline. The price of a barrel of oil is very important to him. And we're starting to see sanctions exceptions for Putin, for Moscow, to sell oil in places or to people that it was previously not allowed to. This lets Russia cash in on the Iran war. It helps them to fund what they're doing in Ukraine. But what else will we see the administration do to try and keep the price at the pump down?
So, you hit it right on the head. I mean, affordability is probably the number one issue going into the midterms. And, President Trump's focus right now is not on affordability. It's on this geopolitical situation in Iran. So other things that you're going to see the White House likely do is, there's ideas like opening up the Strategic Petroleum Reserve or cutting more regulatory red tape. There's going to be a lot of actions that folks over at Treasury and Commerce and Energy are looking at the moment to try and make sure that Americans see that those gas prices are coming down. Now, I think part of it depends on the strategy of Iran. If you see a short-term resolution to this, I hate to use the word transitory, but you would see, prices potentially come down before the American populace begins to think of it in context of the election. election. But if this situation continues and gas prices continue to remain high or go higher, then it's going to start getting into this idea of the election, and that you're going to see the White House try and take even more and more steps to try and get those gas prices down. But the problem is that, for a lot of things that our energy team will tell me, U.S. policy isn't so much the driver of gas prices, it's global policy, and President Trump only has limited options there.
Nathan, when does Congress have to weigh in on a war? I mean, to what extent does the executive have the power to wage a war without asking Congress? And is there a certain time when, Congress has to come in?
So Congress tried to come in this week. Senator Tim Kaine of Virginia actually sponsored a resolution in the Senate that would effectively have President Trump come back and say, well, you need congressional authorization in order to continue the conflict with Iran. I mean, the last time the United States declared war via Congress was back in 1941. Now, both the Senate resolution and the House resolution failed. And I think you're going to see a breather now from that side of trying to get Congress to get back on this game of being the ones that would declare war, for example. I think the next catalyst is if you begin to see the Republican uneasiness of a longer-term conflict, any type of escalation, say boots on the ground or anything. I mean, obviously, nobody's talking about that at this point. But if you get into a situation where this continues and Republicans, especially those that are exposed to the elections in terms of purple districts, begin a little bit more uneasiness with the war, you are going to see Congress try and come back here and say, we need to take a little bit more control of the situation. But for the last 80 years, presidents have had a lot of leeway to do conflicts, and I don't see that changing anytime soon.
All right. At some point, we're going to start getting our tax refunds, and I think the Tax Foundation said those should be 10 to 15% higher than they were last year. That goodwill, though, I imagine, gets eaten up by, again, the price at the pump of gasoline climbing to the highest level that it's been in either of President Trump's terms. What can the Republicans do in Congress to try and counter this? Because they've got to worry about the midterms as well, or have they ceded all of their power to the White House?
So you are going to hear talk of another reconciliation bill. In fact, just this morning, Speaker Johnson was talking about another bite of the apple. Think One Big Beautiful Bill Part 2. Now, we're at a 20-30% chance that a bill can pass. Look, the Republicans only have a margin of 1 in the House of Representatives. And anytime you say, look, we're going to do this, more and more ideas get piled on. And next thing you know, it's a huge thing that's probably not going to pass. So legislatively, I don't think there's going to be all much there. But the thing that we're telling our clients is be careful of President Trump's bully pulpit. Think of just a statement last week when he said he wanted Susan Rice off the board of Netflix. President Trump really doesn't need Congress to do this. He just needs a Truth Social account. And so you're going to see the president take more and more to social media to try and get the bully pulpit to get companies to actually lower prices, and you're going to see more and more of that ahead of the midterm elections. But obviously with only certain ramifications, because some industries will say, yes, we'll actually do what you say. Some industries will say our hands are tied, and it's more the macroeconomic situation that's driving this.
All right, Nathan, thanks very much. Nathan Dean there of Bloomberg Intelligence. Coming up, a major shift in whistleblowing technology. We'll talk to Brittany Kaiser, the CEO of Alphaton, about Vera, a new and anonymous platform built on blockchain technology to help people blow a whistle. This is Bloomberg Open Interest. Reporting fraud without the fear of retaliation. That's the aim of Vera, a blockchain-based whistleblowing platform designed to protect identities and prevent data seizure. Here to talk more about this launch is Brittany Kaiser. She's the CEO of Alphaton Capital, a technology company that operates at the intersection of blockchain, AI, and digital privacy. And I want to get into Alphaton in a moment. But first, this product, Vera, how did you come up with this?
As a former whistleblower myself, I started to see the demand from our current government. Everyone from President Trump to Scott Bessent and Elon Musk have been calling for whistleblowers to submit evidence of fraud, waste, and abuse. And it's not very easy to figure out how to do that and to do that safely.
So how do you use the blockchain to do that? I mean, how do you explain to a layperson who's not, familiar with this technology?
Blockchain is just an operating system that allows for tracking and traceability and accountability. So when a whistleblower uploads evidence to Vera, we can verify that that evidence is real. We can also use privacy technologies to strip off all of the metadata so we can't tell what device they used, their location, any other information about them. And once that evidence, a case is opened, it's verified, and it goes forward, the whistleblower has the ability to decide to reveal their identity just to a law firm so that they can get their whistleblowing reward.
It does sound like a technology that could be used for bad as well as good. How important is the operator?
In the end, the entire point of the technology is that the operator of the technology never has access to the individual or the evidence. And so we've created a platform where we as Alphaton Capital will never see any of that information, but the government department and the law firm will, and be able to take it forward into a case, hopefully to stop fraud from continuing to happen against a government department by a company.
Tell us about your experience as a whistleblower.
I was a whistleblower against my former employer, Cambridge Analytica and Facebook. I still, 8 years later, still participate as an expert witness in cases from the Supreme Court to private cases taken forward. And for me, it was really difficult to figure out who to give that evidence to first. And 27 different government investigations later and around 50 lawsuits, I would have loved to have had something this easy to use back then.
I mean, how painful was it to participate in that?
Again, it's been an 8-year process.
I mean,
so.
beyond the admin, I mean, like the fear of what happens when you're doxxed.
And that's why we wanted to give whistleblowers a choice to submit completely anonymously, where we can guarantee in an open source product that we have no access to that data, and neither will anyone that's receiving that submission. If they are going to get a reward from a case, then of course they can decide to KYC privately with a law firm or with the government department, because now whistleblowers can get 15 to 30% of the reward.
All right. It's a fascinating product, and the company as well. I mean, I think even more deeply tied to what's going on in today's markets, because you're trying to help people who operate artificial intelligence systems hold on to their privacy.
Absolutely. So we've been concentrating on making confidential computing accessible. Right now, that's mostly used by our military. What it means is from the hardware and firmware level, you can run AI without the owners of those AI platforms getting access to any of your data.
All right. Great to spend some time with you. Hope we can get you back here as well. Brittany Kaiser there of Alphaton Capital. Let's get a check of what's going on in the markets right now after a drop of 92,000 jobs for the month of February. This morning, we were looking for a gain of 55,000. We have a sell-off on the S&P. It's down more than 1%, as you can see from this move screen. You can see also that the breadth is largely to the downside. Only 72 companies are gaining today. 426 are falling. The big gainers, to the extent that there are any, Broadcom and Oracle are really the biggest companies there, but you also see Costco, RTX, and Palantir. So you've got some defense companies doing well. You've got some consumer staples companies doing well as, speaking of data and AI, a couple of those players. On the downside, you really do have a lineup of Mag 7 stocks: Apple, Amazon, Nvidia, Facebook, Tesla, all off this morning before we get to banks and financials. JP Morgan, Berkshire Hathaway, Bank of America down as well, holding this market from gains. Energy index is the only one higher of all the industry groups, and that is because of the incredible surge in oil prices, which we'll continue to cover for you throughout the day right here on Bloomberg Television. Tomorrow and Sunday at 7 a.m., tune in for Bloomberg This Weekend. David Gura, Christina Ruffini, and Lisa Mateo will take you through what's going on in Iran and with oil. This is Bloomberg.